Welcome back to Making Money Matter, ladies and gentlemen. David Hunter, he's back. David is the chief macro strategist for Contrarian Macro Advisors. Now, the last time I spoke to David, and we were just talking before, and I said, when was the last time I chatted to you? And David told me 10 months ago, and I said, no way. And then I checked, 10 months. So I've always been saying that the year has gone so fast. So the last time I spoke with David, 10 months ago, a lot has happened since then. Now, David's views have been, some people have laughed at him in the past when he was calling the S&P to go to 6,000. We're going to find out today what he's thinking about the S&P, what he thinks about the markets. This is going to be a macro outlook because, ladies and gentlemen, a lot of people still sitting on the sidelines, a lot of confusion out there. Some of you saying, well, why are gold and silver going up, but the equities are not following suit? So we'll talk about that as well. But welcome back, David. Great to see you. Thanks for joining me.
Yeah, hi, Kerry. It's been almost a year. It's hard to believe.
That's crazy. I think I said this last time, let's not let that happen again. So I'm going to mark my diary and I'm going to harass you because I think we should do this quarterly, because I know last time a lot of people were very, very interested in what you had to say. So let me start off by asking you, at the moment, as I speak to you coming up towards the end of September, we've got a lot of tension in the Middle East. We've got an election in the US coming up. We've got interest rates easing in the US, but not so here in Australia. The RBA here has just said we're leaving interest rates on hold. Love to hear what your views are and where you're calling maybe the S&P going forward.
Sure. Yeah, I've been a big bull, as you know, been probably the bull on the street for the last couple of years. I turned right at the bottom in October 2022. Actually, was bullish before that, but said I think we hit a bottom that day, and it reversed and never looked back. And I've remained with targets that are way above anybody else on the street for a long time. As you say, coming out of October 22, I was at 6,000. I raised my target to 7,000 on the S&P back in January of this year, and raised my target on the NASDAQ from 20,000 to 23,000. I have since raised my NASDAQ target to 24,000.
Wow.
So, pretty steep run from here, in my opinion. I have a 55,000 target on the Dow, which is up from 48,000. And my biggest call is I have a target of 3,300 on the Russell 2000. So that one people have a hard time with because the Russell's been the laggard. But I think you're going to see a big catch-up rally there. And basically from here, it's 50%. So, and I do believe these numbers, I always tell people I'm not tied to the end of the year. I don't give year-end targets. They're really cycle targets. It's the top of what I think is a 42-year secular bull market that started back in August of 1982. So whether it happens, in November, December, January, I don't really care. It's, I'm not going to worry about whether I call it quite that precisely, but I do think there's a real possibility it could be this year that we get there. If we don't get to the final top this year, we'll be darn close. A big part of it will be this year. So, that's a big run from here. And I think probably not the Russell, but I think for the S&P, my number is conservative. So I think it could even exceed that. So I haven't raised it yet, but I'm toying with the idea that I may have to raise that one. So I think it's going to be, I think tech has had a big correction after their great run. Semis have had a big correction. I think they're in gear, and you're going to see those groups lead the market up. So they're going to be joined by a lot of other groups. So it's no longer going to be the case that people can say it's a narrowly based rally. It's not good quality. I think you're going to find that it's a very broad rally into the top. So cyclicals will play, value will play. I think semis, the SMH is maybe 240 now. I think that can get to 400. So there's plenty of upside there. The Mag 7, I think, will continue to be leaders. But at the same time, I think you're going to see industrials play. You're going to see home builders play. You're going to see the materials play. The copper looks great.
Yeah.
You're also going to see things like financials play. So the area that I don't like is the energy area, the oil, the
Oh,
XLE. XLE, I think, is going to lag a lot. It could actually go down, but if it doesn't go down, it's going to at least not be performing very well.
what's
And
why? What's driving that?
well, as much as I've been the bull on the street for equities, I've been the bear on the street for oil ever since it hit 130. WTI oil here hit 130 during the invasion of Ukraine, and then never looked back, never saw that level again. So around 120, I think I said you could see it back down to 85. And then as it got down under 100, I said you could see it down into the 60s. We got down into the 60s a couple times in the last year, and most recently, maybe in the last month. Um, I think it's going to roll over here and probably go to 60 and maybe through 60. So that's really what's driving is there's a surplus of oil out there. The world economy is not great. It's chugging along at a very low rate, and in some cases in recession already. And I think next year I'm calling for a global bust. So, demand for energy is just going to continue to weaken. And meanwhile, supply is, certainly decent. So I'm a bear on oil for this cycle. I think it's had its run. And I'm a huge bull on oil post bust, in the 26 to 30 period, 2026 to 30. I have oil going as high as $500.
What?
So yeah, I think oil can get down to 30 in the bust. And then, once you're going to have a huge response to a global bust. I'm jumping ahead of myself, but you're going to see a huge response from all the central banks around the world, because global bust means big financial crisis, maybe worse than 2008-9 for many countries. For our banks here, I don't think it'll be as bad as 2008-9 because they got hit so hard then, and they've cleaned up their act. They have much less leverage. But for Europe, for your banks, for Canada, for Asia, I think there's plenty of room there for the banks to fail. I mean, so you're going to have banks failing across the globe, and the central banks are going to have no answer for that other than money. You will see. I've said this for a while. I think you will see. We saw 5 trillion in QE out of the Fed in response to the pandemic back in 2020.
Yeah.
I think you'll see 20 trillion this time. That's just the Fed. So, and proportionally, every central bank, your bank doesn't know it yet. They're fighting it right now, but they're going to be forced to do the same thing.
David, there was a lot to unpack there. And one of the things that you said was global bust 26 to 30, that some countries are already in recession. So for me, my brain is just trying to take this all in, going, on the left hand, I'm saying the party's still going. And on the right hand, I'm saying, be careful, it's all going to go to custard. And
yeah, let me go ahead.
Yeah, unpack that a little bit for us, because my brain's now confused. The left.
Yeah, as I said, I jumped ahead a lot. So just to slow down a little bit on the time, I think I'm calling this a melt up. This final stage of this 42-year secular bull market will probably be over, if not this year, and I think it could be this year, sometime in the first quarter of next year. And I really, people will get upset with me because they tell me I keep pushing my timeline. I'm not pushing it. I'm just being realistic that to say that the market can go up 30 to 50% from here, I have to allow for the fact that it's not going to happen in 3 or 4 months. I think it could, because it's going to be a parabolic run, but I have to allow for the fact that it might push to 4 or 5 months. So it'll either be in the fourth quarter or the first quarter. Following that will be this global bust. And it's a global bust refers to the economy and the financial system. But it'll be accompanied by a bear market that I think in the US will be something on the order of 80% peak to trough. 80%.
That's
So, so just using my targets right now, if the S&P tops out at 7,000, I'm saying it could get down to 1,400.
what
I mean,
what so that's like the Great Depression back in the day. So
that 2029 in 1929 we had a 90% peak to trough drop.
correct.
This won't be probably quite that big, but it could be 70 or 80%. And why? Because when I say global bust, I'm using a term to differentiate from anything we've had in the post World War II era. Even 2008-9 was not a bust. It came close, but a global bust is really the system is breaking apart. It's in free fall. We almost got there in October of 2008, but we pulled them back from the cliff. When the commercial paper market froze up, GE was rumored to be going under. We had all the banks pretty much down at zero. The Fed acted, and the Fed and the government acted pretty quickly from that point and prevented us from going over that cliff into a bust.
Yeah.
I'm saying this time they won't act fast enough, partly because of 2008 and everything that's happened since then. I'm focused on the Fed, but I think all the central banks are of the similar mind, and that is we don't want to do QE to infinity anymore. We're done with that. We learned our lesson. We're not going to do that anymore. It's easy to say that until you're faced with a free falling financial system. So they're going to be slow.
Because you said just before, sorry to interrupt you, you said just before, back during the pandemic, they printed, because QE is printing money, basically.
Right.
And you said that during the pandemic, they printed 5 trillion, but you think that the next time it'll be 20 trillion. So they're going to go completely crazy.
Yeah. So right now, if you ask Jay Powell, he'd say, no way, we're not even going to do a trillion. We're never going back there. If you asked every central banker, Lagarde or your central bankers, they'd all say, we're not doing that again. That was a mistake. That's what they think now. But when faced with a system that's blowing up, they only have one tool, and that's money. They can't, you can't ask legislators to move fast enough to save a system that's imploding. So the only thing they can do is push the button and put money out there. So once it's and money happens with a lag, right? They'll put money in to try to stabilize the system, and they'll start, and that's why I think we'll have a bust. Is they'll start trying to be modest with it. They'll say, well, we know we're not going back to 5 trillion. Maybe we can put 1 trillion and stabilize the system, and that'll not do a thing, and we'll continue to see the thing falling apart. They'll put another couple trillion in, that won't do it. All of this will happen over the course of days, weeks, and months, and it will take them probably a good 6, 7, 8, 9 months to get to a right-sized policy. It's one thing to say we're putting money into the system. It's another thing to figure out how much you have to put in. And the only way they'll figure that is when the system finally stabilizes. So for a number of months, their money's they're going to be pouring money in, and nothing's, they're not stopping anything. And while they're trying to figure out what's the right size policy, driven by a mindset that says we shouldn't do this, they're going to be slow to act and act in less than appropriate numbers, less than necessary numbers. And while they're trying to get to that level, reluctantly, you're going to have a free falling system. So that's why it can be a bust. It's we're just leveraged to the hilt. You've got 320 trillion in global debt out there. You've got quadrillions in notional value of derivatives. Derivatives are the leverage on the markets, and obviously debt is the leverage on the system. So you've got double whammy of leverage that's beyond anything we've ever seen in this world, even beyond 2008 and 9 by a lot. So leverage is really what takes you down. When you get into that situation, leverage not only increases the magnitude of a decline, but it speeds up the decline. Everything happens in a much faster fashion. So I think to 2025, you can go from what seemingly today looks like, yeah, we're not gangbusters, but the economy is not showing signs of disaster.
Yeah.
You can go from that in a few short months, all of a sudden say, what happened?
Yeah. No, and I do agree with that. But one of the things that you said is right now we're in a melt up. So you're suggesting that people, and you're calling the S&P 7,000 and possibly a little bit more. So you're saying right now people should not be sitting on the sidelines, that there will be more value now. So what I want to understand is, because the worst thing would be to, and by the way, ladies and gentlemen, this is not financial advice. Go and talk to your financial advisor. Go and sit on the side. Do what you feel comfortable with. I love talking to David because he is a contrarian macro advisor. He actually looks at the markets, but all this conversation might not pertain to you. So it's a crazy world out there. I'm just trying to understand it a little bit more with David. But David, I think from what you're telling us right now is that it's a melt up. There is money. I don't like to call it money. There's currency to be made in these markets right now, but that's not going to last forever. This is a short-term melt up. Am I right in that analysis?
Absolutely right. What I like to say is I am forecasting markets. I'm not. I'm certainly not giving advice. I can't do that.
Yeah.
But I'm also not. Everybody has to kind of look at their own abilities, their own risk preferences, and tolerance, and decide for themselves. Know how nimble you can be. Know your own self in terms of, will you get caught up at the top? Because what I'm telling people is, the likelihood for most people, and there's plenty of exceptions, but for most people, they're most bullish at the top and most bearish at the bottom. So October of 2022, everybody was sure we were going down, including the best of the best, including all the big institutions. They were all sure we were going down to 3,000 or 3,200 on the S&P, or maybe lower. Yeah. The Fed thought we should go down there. So that was where we were 2 years ago. If we go to 7,000, if we go to 24,000 on the NASDAQ, I can almost guarantee you that all those institutions that were bearish, 100% will go. When the market's at 7,000, it'll be a double from 3,500 in 2022. So where they're bearish at half that price, they'll be all in. And so will most retail investors. So what I'm telling people is, yeah, you can say, hey, this is too risky for me. It's too fast markets. I can't go in and get out 3 months later. That's fine. Absolutely. I'm telling you, there's a horrible bear market to follow. So yeah, that's fine. But know yourself, because you may get out. You may say, I'm out and I'm going to stay out now. But if you get another 1,500 points on the S&P, you're going to feel like I'm missing something. And at the top, the narrative is going to be very bullish. People, there's a lot of skepticism around the market right now. Even, most of the strategists on the street are telling you there's not much upside left. It's a high value market. Yeah. And those same people are going to have a rationale. They're going to have a narrative at 7,000 on the S&P that is going to say, there's a long runway ahead, that this market has legs, that it can run for a couple more years because the Fed's easing. Know what the rhetoric's going to be. You have to, the saying over here is, when Wayne Gretzky, who was a great hockey player, used to be playing, it was, how are you so great? And he goes, I skate to where the puck is going to be, not where it is. So you have to think ahead,
yeah,
and know yourself. So my forecast is not an endorsement of any investment approach or advice. It's just saying, this is what I expect the markets to do. You take that information as an individual investor and figure out for yourself, maybe with the help of an advisor, of how you want to do that. Some people can go part way and hedge. Other people will go all in and know that they want to get, at the first sign of trouble, get out. But just know it's going to be very hard at the top to be a seller.
It's hard to be a seller at the top because what? Because psychologically you're like it's going to keep going. Is that what you're saying?
Yeah, one of my big things, the reason I'm a contrarian, is that psychology plays a huge role in investing and
Absolutely.
in markets. And so, in the middle, there's bulls and bears, but at bottoms, almost everybody, the vast majority of people are bearish. At tops, the vast majority of people are bullish. It's just the way your mind goes with what most recently happened and the excitement of being up. Um, and what a contrarian does is try to reverse that. So I'm typically all alone at the top, talking about a very bad bear market, and at the bottom, I'm looked at as crazy because I'm saying the market can go up a lot. So it's just trying to reverse that psychology.
I think it's fascinating, but one of the things that I'm looking at now, what do you think is going to be the catalyst to turn this over from a melt up to a bust?
Yeah. So first, the catalyst for the run up. I want to get that in before we get to the bust, but the catalyst for this last run up, because it seems, people think it's pretty fully valued and doesn't have legs. It's going to be a narrative of, at least in the U.S., the Fed is just beginning an easing cycle that looks like it'll run for quite some time, at least through next year. So they're going to be easing after 2.5 years of tightening, and 4 years since they last cut rates. So you're going to have rates coming down, not just Fed funds rates, not just what the Fed does, but the bond market is rallying and pushing rates down. So I'm calling for a 2.5% 10-year by the end of this year. So we're currently at 375. You could drop another 125 basis points. So you can have rates coming in your favor. You're going to have the Fed easing. You're going to have, I think, this narrative that is there right now is soft landing, at least in the States. So you're going to have that where people are going to say, the Fed did this just right. They tightened enough to get inflation down near their target, and yet they didn't sacrifice the economy. The economy's, flattened out, but it hasn't gone into recession. So I think that for the balance of this year is going to be the narrative. Now, next year, I'm calling for a global bust. So I'm not of that belief.
So,
I'm
so
not.
next year, sorry, just to be clear, next year being 2025, towards the end of next year, because I think just before you said 25, 26. So I'm assuming you mean towards the end of 25, there'll be a bust.
No, well, I think the bust is probably going to, it could start anytime in 25. I think the bottom of the bust is probably late next year, but I think you'll be in a bust most of next year. That seems crazy to be in a melt up months before the bust starts, but nobody's looking at a bust right now. Like I said, that can come fast, and it's possible it takes more time, and it's more mid-year before it gets going. But I think you could have a bust as early as first or second quarter next year, the beginnings of a bust. Because I think,
You're gone.
again, I think the U.S. economy, when it actually officially gets dated, the recession gets dated. What we find, I've been doing this for 51 years, what we find in almost every cycle is that when the National Bureau of Economic Research, NBER, who is responsible for dating recessions, they do them after the fact. And
Yeah.
you don't know until you're out of it. When they look back, almost always the recession started before we knew it at the time.
Yeah.
So I would not be surprised if we're in recession already, because there are certain parts of the economy that are certainly struggling. So we may not be, we may be, 1 or 2% growth, but there's a possibility when they go back and date it, they'll say actually recession started in June or whatever. So it's not so crazy to say that you could even see the bust start, early in 2025, because if you're already in a weak spot, it just tips over into something worse. And of course, that's the U.S. I think the bust is probably going to be triggered by events outside the U.S. because the European banks are very, very much weaker than our banks, or have some potential problems. I think you guys, because of your real estate being up on stilts, are at risk. Canada's in worse shape than we are this time. Last time Canada was great. Their banks were in really good shape, and they didn't learn the lessons of what we went through, and they look like our banks now. Our banks of back then, their real estate's extended and looks like it's problematic. So I think things can come unwound quickly, is all I'm saying. So, but I don't worry too much about when is that going to happen. We'll find it as we get there. All I know is that for the next several months, meaning the balance of this year or certainly the next few months, um, the the stock market is not going to be bothered by anything. I don't think. I think there's enough of evidence that this economy is holding together that people will be focused on the fact that the Fed's easing, that rates are coming down, that the dollar is starting to fall, and that China's back on board.
Yeah.
China's finally easing again. So you got global liquidity is starting to lift. That's also a bullish sign. So then,
yep. So I just want to, if you're a nervous Nelly, you'd stay out of the markets right now, because you're never going to people can never pick the top and the bottom. And
absolutely.
So I think that if you're a nervous Nelly, it's coming. And I tend to agree with you, David, that you can't keep the party going in the craziness of propping it up and bringing those interest rates down forever. At some point, it's going to pull apart.
Yep, and we've gotten there from leverage. I mean, China's found that out. Their whole so-called miracle of the last cycle was really debt. I mean, they just blew their debt way up, and it was a great party. But then they ran into the problems. Now you got the hangover, and they're struggling to figure out what to do with that hangover, because a lot of it's real estate, and their consumers aren't spending. And I think they're really finally at a point where they're saying, this is kind of what I'm saying we're going to be at next year. We didn't want to have to go back here, but our economy's not going to respond unless we print some more money, unless we do some of these easing things. So I think they're feeling like they don't have a choice, because their economy's starting to really, they're seeing deflation, as you know. So, and by the way, the global bust I talk about next year, I think it will be a global, and again, this is a global, not just US, a global deflationary bust. So I think we'll actually have deflation next year.
Wow, next year,
and
deflation.
And not just asset deflation, actual price deflation.
Some people will say, thank God, that's about time. Do you think that the gold I guess the precious metals market is seeing this right now? Because we've got gold at all-time highs, silver's yet to catch up. The commodities, the equities, if you like, that hasn't played catch up at all. But it feels like gold's got a crystal ball and is saying, you know what, we're going to be okay in the precious metals area, but everything else is going to go to custard.
Yeah, I think gold and silver look great. I want to just say one last thing before we leave the equities, because I think I confused you and I probably confused the audience. The 26 to 30 dates that I threw out there, 2026 to 30, that is not the global bust. That is the next recovery. So the bust only lasts maybe a year, 12 to 18 months. So by the second half of 2026, we should be in a new recovery. Why are we going to be in a new recovery? Because the Fed will have printed $20 trillion, and every other central bank will have printed proportionally similar. So that money will trigger a recovery, but it'll also trigger a huge inflation cycle. And that's why I say oil to 500. And I'll just throw a couple more since we're talking about gold and silver. My target for gold and silver by the end of this decade or early next decade, gold 20,000, silver 500.
That's a big call. That's even bigger than Jim Rickard's call.
Oh yeah, no, we are going to see an inflation cycle that is going to go beyond anything we've seen, beyond the early 80s. I was here in the late 70s, early 80s when the US saw 20% inflation. I think by the early next decade, if not late this decade, we could be looking at 25% inflation in this country. So you'll be dealing with whatever yours is going to be proportionally to that. We're going to have a massive inflation cycle, and it's, so commodities will be the story once we get beyond the bust, but everything's going to get hit in the bust. So you can't straight line it from here. My targets, I'll back up and say my gold target for during this melt up between now and the end of the first quarter of 2025, I just raised my target on gold from 3,000, which I had 10 months ago when we talked. I just raised it to 3,400. So that's where I think gold's going in the next 6 months.
All right, are you listening, gentlemen? Are you all listening? I really, really want you to pay attention, because as David said just a moment ago, he's been in these markets for over 50 years. He's seen the cycles, he understands the cycles, and he understands that when you're a contrarian, that's when you not only preserve capital, but you can actually make it. Now, I want all of you out there to be making it and not to be saying, oh my gosh, I've lost all my capital. You've got to preserve and gain capital during these times. And that means listening to people like David, but making sure you take your own advice. David, back to you.
So gold to 3,400. Silver, I had a 60 target on that when we last talked. I raised that in July to 75. So I'm looking for silver between now and the end of the first quarter of next year to go to 75. We're down at 32 now. I wouldn't be surprised if we get a short-term pullback here, back just under 30. And we may not, but I wouldn't be surprised by that. But then I think it's pretty fast run to 75 in the next 3 to 6 months.
Do you see? Sorry to interrupt you. Do you see a little bit of a pullback in the gold price as well? Because that's what I'm hearing.
It doesn't have to. I'm sorry. Doesn't have to, but I wouldn't be surprised if you got $100 pullback in gold. It's not. You're not going to do a lot. I mean, you're not going to go from. We're almost 2,700. You could go back, or 26 something. You could go back to 2,500. I think at the most. You might not get back much below, 2,550 or 2,575, but whatever pullback is going to be short lived. And it may not. We may just be in the go period for both metals. But it does look to me like I could see 29.5 on the silver chart. I don't know if we'll do it, but I can see it. And if we do that, then it'll be a quick run from there, up over 40 and keep going.
Yeah, and a lot of people I talk to, they're saying, oh, but gold is so expensive. And I keep saying to them, you don't get it. It's actually not gold being expensive. It is the purchasing power of your paper that is being devalued faster than you can actually see. Would I be right?
And precisely, the gold in other currencies has done a lot better than gold in the U.S. over the last several years.
Yeah,
Australian dollars been weak, and gold has done far better in Aussie, right, than in the U.S. dollar. So now it's the U.S. dollar's turn to fall out of bed, and I'm calling for the dollar, which is down around 100 and a half, to go to 80. And that's between now and probably second quarter next year. So that's what I think. That's why I can be so bullish on the metals. It's in dollar terms. I don't know what it'll do in Aussie terms, because I think the Aussie, which is what 0.68 versus a dollar, I think. Yep. 0.6875 or somewhere in there. I'm calling for the Aussie to go up to 0.85.
Yeah, I agree with you.
Yeah. So, and the euro, I have the euro going to 1.3, 130, from wherever it is, 117, 18, wherever. So, other currencies, gold may not do as well, but in the US dollar, gold's in its sweet spot right now and is going to keep going.
All right, we're running out of time, David. What I'd love you to do is, there was a lot to take in there. Melt up, bus. But one of the things you made very clear is that 26 to 30 was a recovery phase, but that we are going to be seeing that global deflation, but then massive inflation going forward. So I'd love you to give us 3 things that you think people should be doing right now as we go forward. And by the way, I think you and I should talk in December, because I think this could go so fast that 10 months is too long. So let's talk again in December, because I know how busy you are. So I'm going to pop that in now and say you and I need to talk in December. But
yeah, I'd be glad to do that. So I'm not going to give 3 action points, and because it'd be advice. But what I can say, it gives me a chance to go back and say, we're in a unique period where the returns I'm talking about over the next 3 or 4 or 5 months are returns that you would normally take 2 or 3 years to get. Particularly in the Russell 2000, if it goes up 50% in 3 or 4 or 5 months, 50% would be returns you might get over 3 or 4 years normally.
mm-hmm.
So even though we're within a few months of a top, and I would normally say nobody's smart enough to pick a top, and you're better off being early than late, and those are all true.
Mm-hmm.
I also think you have to factor in the fact that we're in a period unlike in my 51 years, I've never seen a period like this. The closest thing was the NASDAQ run up in 99, 2000, a parabolic run. But we're about to see a historic parabolic rally that I think may be the biggest in history. And so, kind of going back to what I said before, you could come out now and it'd be prudent to say I'm either pretty hedged or I'm out, because I can't be that smart to pick the top, and then see 30 or 40% that you missed and feel you got to scramble and get in, and then you catch the top and ride it down. So you just have to understand that dynamic, I think, is the first and foremost. And some people will be very nimble and be able to stay bullish and do it all right. The other corollary, or the other connection to that same statement, is you don't want to be late, because the other side of the mountain is going to be equally steep. I'm calling you, if I'm right about an 80% bear market, it'll probably happen over 8 to 10 months. You'll have, a big step down where you're down 30, 40% or more, and then a big counter trend rally that gives, catches back half of that loss, and then another big leg down to lower lows, and maybe a third leg down. So I'm guessing it'll be, a big part of next year, 8 to 10 months of next year, you'll see that. So, but that's pretty fast. I mean, and you're going to feel like, look at the tech sell off, look at the semi sell off of the last few months. That should give you some idea of how quick things can go the other way. Everything looked great, and then all of a sudden you go, wow, I just lost 40% of my semi position. So just understand that we're in a very unusual, and that's what happens at the end of a 42-year cycle, is things get very volatile. And so that's kind of the message. The other message, because we didn't talk about it, is bonds. I think bonds will be there'll be a big separation between treasury bonds and corporate bonds next year. Right now, all bonds are going up. Interest rates are coming down, and all bonds are going up. Like I said, I think the 10-year can go to 2.5 this year. I'm calling for the 10-year U.S. Treasury to go to 0 next year in the midst of the bust, because what is QE? It's buying up every treasury you can get. The Fed will be buying every treasury they can get. Institutions will be buying treasuries because they don't want to be anywhere else. They're looking for the guarantee from the government. They're looking for safety. Foreign investors will be buying treasuries. So next year, treasuries will be in huge demand, and there won't be enough supply, and it'll go to, if not 0, pretty close. Short rates probably go negative at the bottom of the bust. So rates will be down. What won't be down is junk rates. I mean, the spreads between treasuries and junk are going to go wide, very wide, because in a bust, junk is going under. A lot of junk, you're going to have a lot of defaults. So everything from investment grade to junk, spreads are going to widen a lot. So the only game in town in bonds will be treasuries. And the sooner you realize that, and it really can start. You can make money in corporates now because there is a rally with stocks for a while yet. But just like when the stocks top out, so will corporate bonds. And from there, it's all downhill for bonds, except for treasuries. Treasuries will be one of the few assets in anywhere that will hold value during the bust. They'll be going up while almost everything else is going straight down. So I don't even think metals can hold up. Even gold, I think, will be hitting the bust.
Oh,
It's
wow.
it's a deflationary bust. So that's the probably the other important point I should make before we close is it won't be a straight line for gold or silver, but certainly not silver, but even gold. If we go to 3,400 on gold, I wouldn't be surprised to see gold back. Maybe not at the breakout point at 2,100, but certainly back to the mid 2000s. So you could go from 34,500 back to 2,500 or 2,400. You know, it won't be as bad as the markets, but it'll be a big hit. So you can't straight line it and say I'm just going to hold. Well, you can, but just know your risk. If you hold it straight through from now until the end of the decade, there's that canyon in between. As I say, it's like in the U.S. standing on the south rim of the Grand Canyon and looking across to the north rim and thinking you can walk straight across. There's this huge canyon in between. You can't walk across. So same thing with the metals. You know, there's a period there where you may not want to hold it, but then get in, you know, at the bottom of the bust, and you'll have. I think gold and silver will be, if not the highest performing assets of the rest of the decade, certainly among them, along with energy, and every other commodity. It'll be a commodity cycle like we've never seen.
That's what I think. Yep.
Meanwhile, because interest rates will go through the roof after the bust, after this last run, particularly in treasuries, you'll have your peak in treasuries at the bottom of the bust or soon thereafter. From there, treasuries will not have a positive tick until next decade. You know, it's because you're going to have, if inflation goes from negative deflation, negative inflation,
yep,
to potentially 25%, interest rates are going to, the 10 years going to go from 0 to 20%. You do not want to own bonds 26 to 30. You know, it's going to be a time for other things, not bonds.
All right. No bonds in the 26 to 30. Don't worry, ladies and gentlemen. I will be getting him back in December. We're going to sort that out very quickly. But for now, David Hunter, you can follow him on X. I'll put the links below. And David, it's been great to chat to you. Boy, are we in for a crazy ride. We won't leave it 10 months next time. Thanks so much for joining me.
Okay. Thanks, Kerry.